The financial world received a definitive piece of data this week that alters the long-term investment landscape for the United States economy. Reports from major financial news outlets have confirmed that the China Investment Corporation is actively seeking to offload a massive portfolio of assets. We are not discussing a routine rebalancing of liquid stocks or a standard adjustment of currency reserves by a central bank. The Sovereign Wealth Fund of China is hiring secondary advisors to sell approximately $1 billion in illiquid private equity stakes. These are long-term, binding limited partnership interests in American companies held through top-tier firms like the Carlyle Group and KKR. The specific asset class is designed to be held for 10 to 12 years, representing the sticky capital that underpins long-term economic stability. The decision to sell these assets on the secondary market before maturity is a significant deviation from historical investment behavior. It indicates a strategic shift in Beijing's risk tolerance regarding the jurisdiction of the United States and its financial system. For the first time in decades, the smart money in the East is accepting a guaranteed discount to exit the West immediately. This is a mathematical signal that the era of deep financial integration between the world's two largest economies is structurally fracturing. We need to analyze the mechanics of this sale and exactly what it tells us about the future of capital flows. Before we dive into the technical details of this liquidity drain and its impact on your portfolio, I have a request. Please subscribe to the channel right now to ensure you receive objective, data-driven financial analysis that the algorithm often overlooks. We focus on the hard numbers and the plumbing of the financial system, not the sensationalist headlines that distract retail investors. And please leave a comment below stating the city you are watching from so we can track our global audience reach. To understand the gravity of this $1 billion sale, you must first understand the entity behind the transaction. The China Investment Corporation is one of the world's largest sovereign wealth funds, managing over $1.3 trillion in assets. They are a sophisticated institutional investor that has historically provided massive liquidity to the U.S. private equity and real estate markets. When a fund of this magnitude makes a move, it is never an impulsive decision. It is a calculated geopolitical maneuver. They are effectively the limited partner, or LP, behind many of the deals that buy out American software companies, hospitals, and factories. By listing these LP stakes for sale, they are sending a message to the general partners on Wall Street. The message is that they no longer view the United States as a secure vault for their generational wealth storage. This move is likely driven by a reassessment of jurisdictional risk following the freezing of Russian central bank assets in 2022. The CIC risk managers have likely concluded that in a Taiwan conflict scenario, their U.S. domiciled assets would be seized instantly. Therefore, the only rational fiduciary move is to repatriate that capital or move it to a neutral jurisdiction while they still can. This $1 billion tranche is likely a pathfinder sale designed to test the depth and pricing of the secondary market. If they can exit these positions without taking a catastrophic haircut on the price, we should expect to see volume increase. There are tens of billions of dollars in similar Chinese legacy assets trapped inside U.S. private equity structures right now. The secondary market for private equity is where these illiquid stakes are traded between institutional investors, usually at a discount to net asset value. When a seller like the CIC enters the market with urgency, buyers will demand a significant discount, perhaps 20% or more. The fact that the CIC is willing to swallow this loss speaks volumes about their urgency to decouple from the dollar system. But the impact of this sale goes far beyond the balance sheet of the China Investment Corporation or its buyers. It impacts the valuation metrics of every other private equity portfolio held by American investors, including public pension funds. When a large volume of assets is sold at a discount, it resets the pricing benchmark for the entire asset class. If the CIC sells a portfolio of U.S. tech companies at 80 cents on the dollar, that becomes the new market price. American pension funds, which are heavily allocated to private equity, will have to mark down their own holdings to match this reality. This leads to a denominator effect, where the perceived value of pension assets shrinks, potentially triggering funding gaps for retirees. We are watching a deflationary waveform in the private markets that has not yet hit the public stock indices. The transmission mechanism for this pain is the capital call structure of private equity funds that rely on foreign money. Typically, a private equity firm secures commitments from sovereign wealth funds and then calls the capital when they find a deal. If the Chinese sovereign wealth funds are retreating, the pool of available capital for new American deals shrinks considerably. This scarcity of capital means that the cost of equity for American businesses must rise to attract new investors to fill the void. Higher capital costs mean fewer corporate expansions, fewer mergers and acquisitions, and ultimately slower GDP growth for the U.S. economy. This is the hidden economic cost of geopolitical fragmentation that is rarely discussed in the mainstream financial press. We often talk about tariffs and trade wars, But the capital war is far more damaging to the long-term efficiency of markets. The exit of the CIC removes a price-insensitive buyer from the market, leaving only price-sensitive domestic buyers. Domestic buyers, like U.S. insurance companies and family offices, simply do not have the infinite pockets of a sovereign state. They will require higher returns and lower entry prices to take the risk, forcing asset values to correct downward. This correction will be felt most acutely in the sectors where Chinese capital was most active: technology, healthcare, and logistics. These industries have enjoyed a premium valuation for years, partly because of the flood of global liquidity chasing them. As that tide recedes, we are going to discover which companies have strong fundamentals and which were just riding the liquidity wave. The timing of this sale is also critical, occurring during a period where U.S. interest rates remain historically high relative to the last decade. Private equity firms are already struggling to exit their investments because the IPO market has been sluggish and debt is expensive. Adding a massive motivated seller like the CIC to this environment creates a supply-demand imbalance that is dangerous for prices. It creates a buyer's market where the few institutions with cash can dictate terms to the largest sellers in the world. We must also consider the signaling effect this has on other non-aligned sovereign wealth funds around the world. If China is getting out, funds from the Middle East or other emerging markets might reevaluate their own exposure to U.S. sanctions risk. We could see a slow-motion rotation of global capital away from the U.S. dollar sphere and into neutral assets like gold or commodities. This creates a structural headwind for the U.S. dollar and U.S. asset prices that could last for an entire generation. The CIC's move is consistent with the broader data we are seeing regarding foreign holders of U.S. Treasury debt. It is part of a comprehensive strategy to de-dollarize the Chinese national balance sheet across all asset classes, not just bonds. They are swapping paper promises for strategic autonomy, even if it costs them billions in realized losses in the short term. This indicates that Beijing is prioritizing national security and resilience over pure profit maximization in the current climate. For the American investor, this means the PE expansion era driven by globalization is likely coming to an end. We are entering an era of PE contraction, where geopolitical risk premiums must be factored into every single stock valuation. You cannot value a company the same way when the world's second largest economy is actively dumping its shares. The selling pressure from the CIC effectively puts a ceiling on how high certain valuations can go in the near term. Wall Street banks that act as intermediaries in these sales are in a delicate position, collecting fees while managing the decline. They are facilitating the exit of their biggest historic clients while trying to maintain confidence among their domestic clients. It is a high-wire act that reveals the inherent conflict of interest at the heart of the modern global financial system. The private equity retreat is also a direct threat to the dry powder narrative that Wall Street often promotes. Analysts often claim there is trillions of dollars in dry powder waiting to buy the dip, but much of that was foreign. If the foreign portion of that dry powder is actually looking for an exit, the safety net is much smaller than we thought. This could lead to increased volatility in the markets as liquidity dries up during moments of stress or panic. We are already seeing signs of this liquidity stress in the commercial real estate market, which is closely tied to private equity. Many private equity funds own massive portfolios of office buildings and logistics centers that need to be refinanced soon. With the CIC pulling back, the pool of capital available to refinance these debts is shrinking rapidly. This increases the probability of defaults and foreclosures in the commercial property sector, which hurts regional banks. The interconnectedness of these systems means that a decision in Beijing ripples through to a regional bank in Ohio. This is why we cannot ignore a $1 billion transaction. It is a symptom of a systemic shift in the plumbing. The CIC is essentially deleveraging its relationship with the West, reducing its surface area for potential financial attacks. This defensive posturing suggests they believe the probability of conflict or severe sanctions is rising, not falling. Smart investors watch what the whales do with their money, not what the politicians say in their speeches. And the whale is swimming away from the United States, taking its liquidity to safer harbors or bringing it home. We must also ask, who has the capacity to absorb this supply of assets without crashing the market price? It will likely be the large U.S. asset managers like Blackstone or Apollo who step in to buy these stakes at a discount. This consolidates even more ownership of the U.S. economy into the hands of a few domestic financial giants. While this keeps the assets in American hands, it concentrates risk and reduces the diversity of the investor base. A diverse investor base is essential for a healthy market because different players have different time horizons and goals. If everyone in the market is a U.S.-based fund with the same constraints, the market becomes fragile and prone to groupthink. The exit of the CIC makes the U.S. market more insular, more correlated, and ultimately less resilient to shocks. This is the unseen risk of financial nationalism. It reduces the shock absorbers that global capital provides. As we move forward, we need to monitor the secondary market reports very closely for more bulk sales. That would be the signal that the Cold War in finance has turned into a hot war of capital liquidation. It is a prompt to review your own exposure to illiquid assets and companies dependent on foreign funding. The great rotation of capital is underway, and it will create winners and losers, just like the last 40 years did. But the winners of this new cycle will be those who understand the reality of a fragmented global financial system. They will be the investors who prioritize liquidity, tangible value, and jurisdictional safety over speculative growth. The CIC has shown its hand, and now the rest of the market must decide how to play the next round. This is not just a financial story, it is a historical pivot point that marks the end of an economic era. The implications will play out over years, but the mechanism of the separation has been activated this quarter. Stay focused on the flows of capital because they tell the truth when the narratives are confusing. The immediate financial consequence of this liquidation signal is a violent and unavoidable repricing of risk across the entire asset class. When a market giant like the China Investment Corporation sells at a steep discount, it effectively sets a new global floor for prices. This triggers what financial analysts call a mark-to-market event, and it represents the absolute nightmare scenario for institutional pension funds. If the CIC sells a portfolio of American software companies at 80 cents on the dollar, that price becomes the new reality. It effectively forces every other holder of those same assets to write down the value of their holdings instantly to match the trade. The California Public Employee Pension System, or the Teachers Retirement Fund in Texas, holds these exact same private equity funds. They are sitting in the same limited partnership structures alongside the Chinese sovereign wealth fund, exposed to the same underlying assets. When the Chinese exit doors hit and the price drops, the remaining partners are left holding assets that are suddenly worth 20% less. This creates a massive gaping hole in the balance sheets of American pension funds that are already severely underfunded and struggling. They were counting on those assets maturing at par or higher to pay for the retirement of millions of hardworking Americans. Now they are staring at realized losses that were triggered by a cold, calculated geopolitical decision made thousands of miles away in Beijing. This is how a diplomatic rift transforms into a solvency crisis for the American retirement system without a single shot being fired. The secondary market for private equity is usually a sleepy, opaque corner of finance where liquidity is provided quietly and slowly, but when billions of dollars in urgent supply hit that market all at once, it completely overwhelms the available buyers. This supply shock drives prices down further, creating a downward spiral of valuation resets across the entire private equity industry. We are witnessing the rapid deflation of the private equity bubble that was inflated by a decade of cheap global money. For years, private equity firms could claim their assets were worth whatever their internal models said they were worth, ignoring volatility. They didn't have to mark them to market every day like a stock trading on the New York Stock Exchange, hiding the volatility. But a bulk sale by a sovereign wealth fund rips away that veil of secrecy forever and exposes the true market clearing price. And the true market price, absent the flood of Chinese liquidity, is significantly lower than what is currently held on the books. This repricing event will force American investment firms to send out incredibly painful letters to their limited partners in the coming quarters. They will have to explain why their stable funds are suddenly showing negative returns despite a booming public stock market. The disconnect between the S&P 500 making new highs and the private markets taking massive losses is growing wider by the day. This divergence is dangerous because it masks the structural rot happening underneath the surface of the real financial economy. But the damage is not limited to paper losses in pension funds. It extends physically to the commercial real estate market. A significant portion of these private equity portfolios consists of prime commercial real estate assets located in major U.S. cities. The CIC and other Chinese state entities were aggressive buyers of U.S. office towers, luxury hotels, and logistics hubs for years. They bought these assets at peak prices, fueled by the belief that American real estate was the ultimate safe haven for capital. Now, faced with a domestic property crisis at home involving developers like Vanke, they need cash immediately to cover domestic debts. They are becoming forced sellers of American real estate exactly when the U.S. market is already freezing up due to rates. The commercial real estate sector in the U.S. is facing a refinancing wall of trillions of dollars in maturing debt this year. Office vacancies are at record highs in cities like San Francisco, Chicago, and New York due to the shift to remote work. Adding a wave of aggressive Chinese selling to this fragile market is like throwing a lit match into a pool of gasoline. We are starting to see trophy assets, prestigious buildings in downtown locations, selling for massive discounts just to clear the books. In some cases, prime buildings are trading for less than the value of the land they sit on, wiping out the equity completely. This destroys the comparable sales data that banks use to value every other commercial loan on their balance sheets. If one building sells for a 50% discount, the bank has to assume the building next door is also worth significantly less. This triggers margin calls for American developers who have nothing to do with China but are caught in the valuation crossfire. The contagion effect spreads from a decision in Beijing to a developer in Manhattan, and then to a regional bank in Ohio. Regional banks are the biggest lenders to the commercial real estate sector, and their solvency is now directly at risk. If they have to write down the value of their loan portfolios, they will stop lending to small businesses to conserve capital. This brings the credit crunch right to the doorstep of the average American entrepreneur trying to get a line of credit. The withdrawal of the CIC acts as a catalyst that accelerates the inevitable and painful correction of the U.S. property market. It removes the floor of demand that kept prices artificially high for the last 10 years of the credit cycle. But there is another sector that is even more dependent on this foreign capital than real estate, the American technology sector. Silicon Valley has operated on a massive surplus of venture capital funding for over a decade, driven by global sovereign wealth. Funds like the CIC were major backers of the late-stage growth equity rounds that created the famous unicorn companies. These are the startups valued at over $1 billion that stay private for years before eventually going public. They relied on massive checks from sovereign funds to subsidize their losses and grab market share aggressively from competitors. With the CIC retreating, that source of dumb money, capital that doesn't demand immediate profit, is gone from the valley. American venture capital firms are now struggling to raise new funds to support their existing portfolio companies through this drought. We are seeing a sharp rise in down rounds, where startups have to raise money at a much lower valuation than before. This wipes out the equity of employees and founders, destroying wealth in the innovation hubs of California and New York. The Series C and Series D crunch is real, and it is killing companies that could have been the next big thing. Without the cushion of Chinese capital, these companies are being forced to cut costs, fire staff, and pivot to profitability immediately. This sounds healthy in theory, but in practice, it means a massive contraction in the high-paying tech job market. The layoffs we are seeing in the tech sector are partly a direct result of this global liquidity tide going out. Companies can no longer burn cash to grow. They must survive on their own revenue, which is a painful transition for many. The CIC's exit essentially creates a funding winter for American innovation that could last for several years of stagnation. This allows China's own domestic tech sector to catch up while American firms are starved of the capital needed to scale. It is a form of asymmetric economic warfare where they weaponize our dependence on their money against our own industries. They withdraw the drug of cheap capital, and the American tech sector goes into severe withdrawal symptoms and contraction. This brings us back to the role of the general partners, the Wall Street firms tasked with managing this difficult transition. Firms like Blackstone, KKR, and Carlyle are now shifting their focus to raising money from retail investors like you. You have probably noticed more advertisements for private equity products targeting individual investors and 401k accounts recently. This is not a coincidence. It is a desperate attempt to replace the lost sovereign capital with American household savings. They need a new source of liquidity to keep the fee machine running and to buy out the exiting Chinese stakes. They are trying to offload these illiquid assets onto the American middle class just as the smart money exits the building. It is the classic bag holder strategy. Sell to the public when the institutions want out of the trade to protect themselves. You need to be extremely wary of any exclusive private equity offers entering your retirement accounts or brokerage right now. You are effectively being asked to provide exit liquidity for the China Investment Corporation at the absolute top of the market. The democratization of private equity is a marketing slogan designed to cover up a liquidity crisis at the institutional level. Institutional investors are leaving the room, and retail investors are being invited in to pay the final bar tabs. This transfer of risk from the geopolitical level to the household level is the untold story of the financial year. We must also consider the currency implications of this massive repatriation of capital back to the Chinese mainland. When the CIC sells U.S. assets, they receive U.S. dollars in exchange for their equity stakes in these companies. They then have to sell those dollars and buy renminbi or gold to complete the repatriation process effectively. This creates structural selling pressure on the U.S. dollar and buying pressure on the Chinese yuan and physical gold. This aligns perfectly with the broader de-dollarization trend we are seeing across the BRICS nations and emerging markets. They are using the proceeds from these sales to strengthen their own currency and buy hard assets that cannot be sanctioned. It is a wealth transfer from the U.S. financial system to the Chinese state balance sheet that weakens the dollar. They are trading paper wealth, which can be frozen, for sovereign wealth, which is under their direct control. This strengthens their hand in any future conflict over Taiwan or trade tariffs initiated by the Western alliance. If they have less exposure to the dollar, the U.S. Treasury has less leverage to sanction them effectively in a crisis. The mutual assured destruction of financial interdependence is being dismantled piece by piece, day by day. We are moving toward a world of mutually assured separation, where the two economies operate independently and competitively. This separation will lead to higher inflation in the U.S. because we lose the deflationary benefit of Chinese savings flows. For decades, China recycled its trade surplus back into our markets, keeping our interest rates artificially low. If that recycling mechanism breaks, U.S. interest rates must rise to a new, higher equilibrium level to attract capital. This means mortgage rates, car loans, and credit card APRs will stay higher for longer than anyone currently expects. The Federal Reserve cannot fix this problem because it is a structural flow issue, not a cyclical business cycle issue. They cannot print money to replace the China Investment Corporation without causing hyperinflation that destroys the currency. So the American consumer is left to absorb the cost of this geopolitical divorce through higher borrowing costs and inflation. The $1 billion signal is just the tip of the iceberg of this structural shift in global finance. There are hundreds of billions more in soft power investments that China holds in U.S. universities and endowments. We are seeing reports of Chinese donors pulling funding from Ivy League schools and elite research institutions across America. This endowment exit is another layer of the retreat that hurts the American innovation ecosystem at its academic core. Universities rely on this capital to fund research labs and scholarships for top global talent in science and engineering. As this money leaves, the budget deficits of these institutions explode, leading to higher tuition costs for American students. Every layer of the American system that touched Chinese money is now feeling the vacuum it leaves behind. The decoupling is not just a political talking point on cable news, it is a painful financial reality. And while the media focuses on the stock market daily moves, the tectonic plates are shifting underneath the foundation. The private markets are the bedrock of the economy, and that foundation is cracking under the pressure of withdrawal. The liquidity drain is slow, steady, and relentless, like a leak in a massive dam that cannot be plugged. Investors who are positioned for a return to normal are going to be blindsided by this new financial reality. There is no returning to the pre-2022 world of global cooperation and free-flowing capital across borders. The walls are going up, and the capital is retreating behind them for safety before the storm hits. We are witnessing the end of the globalized investment cycle and the beginning of a fragmented, volatile era. The implications of this shift will define the winners and losers of the next decade of investing. You need to know where the money's going, not just where it is leaving from, to survive. Because as the CIC exits the stage, a new set of rules is being written for the game. The ultimate destination of this fleeing capital is the most critical piece of the entire financial puzzle. When the China Investment Corporation exits the United States, they are not simply sitting on a pile of digital cash. They are aggressively redeploying that liquidity into the only asset class that has no counterparty risk, physical gold. We are witnessing the greatest rotation from paper promises to hard assets in the history of modern finance. The People's Bank of China and its sovereign funds have been buying gold for 18 consecutive months without pausing. But the official numbers reported to the World Gold Council are likely a fraction of the true volume. They are stripping the London and Swiss vaults of physical bars and shipping them directly to Shanghai. This is not a trade. It is a strategic fortification of their national balance sheet against the US dollar. They are building a gold wall to protect their currency from the inevitable sanctions that would follow a Taiwan conflict. By backing their currency with metal, while the US backs its currency with debt, they are flipping the script. They are betting that in a fractured world, he who holds the physical collateral makes the rules. This rotation creates a massive floor for commodity prices, even if the global economy slows down into a recession. In the past, a recession meant falling oil and metal prices, but that correlation is breaking down before our eyes. Now, commodities are being monetized as store of value assets by sovereigns who no longer trust Western government bonds. This is the commodity supercycle that will define the next decade of investing, driven by geopolitical mistrust. For the American investor, this means the traditional 60-40 portfolio of stocks and bonds is fundamentally broken. Bonds can no longer be the safe haven in your portfolio if the largest foreign creditor is dumping them. If China is selling treasuries, yields must rise, which means the price of the bonds in your portfolio must fall. This creates a scenario where both stocks and bonds can fall simultaneously, leaving you with nowhere to hide. We saw a preview of this in 2022, but the next leg down will be driven by structural sovereign selling. The only assets that perform well in this environment are those that cannot be printed by a central bank. Energy, agriculture, precious metals, and defense industrial capacity become the new defensive assets for the 21st century. This is a complete reversal of the investment logic that made people rich from 1980 to 2020. During that period, you bought growth and tech and ignored stuff because stuff was cheap and abundant. Now, stuff is becoming scarce and strategic, while growth is becoming expensive and risky due to interest rates. The exit of Chinese capital from the US private equity market is just the bell ringing to announce this shift. It is telling you that the era of financialization, making money from money, is ending, and the era of tangible value is beginning. But there is a darker implication for the US domestic economy that we must confront honestly as analysts. If foreigners stop buying our debt, the United States government has only two options to fund its massive deficit. Option one is to cut spending drastically, slashing Social Security, Medicare, and the defense budget overnight. Option two is to force domestic institutions to buy the debt that China and Japan are no longer buying. This is known as financial repression, and it is already starting to happen in the plumbing of the system. Regulators will likely change the rules to force banks and pension funds to hold more U.S. Treasury bonds by law. They will treat your retirement savings as a captive pool of capital to fund the government's operations. This is why you are seeing new regulations about liquidity coverage ratios and capital requirements for big banks. It is a stealthy way of forcing the banking system to absorb the supply of bonds that China is dumping. Ultimately, this results in a transfer of wealth from savers to the government through negative real interest rates. Your savings account might pay 4%, but if inflation is 6%, you're losing purchasing power daily. This is the inflationary endgame that allows the U.S. to erode its debt burden without formally defaulting on it. China sees this coming, which is why they're getting out now, before the inflation fully destroys the dollar's value. They are refusing to be the bag holder for the United States' fiscal irresponsibility and unpayable debt levels. The $1 billion signal from the CIC is their way of saying they will not subsidize our standard of living anymore. For the average American household, this means the cost of living is going to remain structurally high forever. The Walmart era of cheap goods imported from China, funded by cheap debt sold to China, is over. We are entering the reshoring era, which is patriotic and resilient, but inherently much more expensive for everyone. Building factories in Ohio costs more than building them in Shenzhen, and that cost will be passed to you. Borrowing money without China's savings pool costs more, and that interest rate will be passed to you. The private equity retreat is the financial market pricing in this new, expensive reality of American isolationism. And Wall Street hates this narrative because it is hard to sell high-fee products in a world of structural inflation. They want you to believe that AI will solve everything and that we will return to 0% interest rates soon. But the data from the China Investment Corporation suggests that the smart money knows that is a fantasy. They know that AI requires massive amounts of energy and chips, which are physical constraints we haven't solved. And they know that rates cannot go to zero when the US government needs to refinance $35 trillion in debt. So, how do you protect yourself in this environment of the Great Unwinding and capital flight? First, you must eliminate variable rate debt from your personal balance sheet as aggressively as possible. Credit cards and adjustable rate mortgages are financial suicide in a world where foreign capital is leaving. Second, you need to have exposure to the anti-bubble assets that China is buying, not selling. If the smart money is moving into gold, energy, and commodities, you should probably have some insurance there too. Third, you must scrutinize the stability of your own job and industry in a de-globalizing world. If your industry relies on cheap Chinese supply chains or Chinese investment capital, you are vulnerable. Sectors like domestic healthcare, defense, and essential services are safer bets than luxury goods or speculative tech. The Great Unwinding will create a massive transfer of wealth from the oblivious to the prepared. Those who are holding the assets that the world needs, energy, food, metal, will see their wealth preserved. Those who are holding the paper assets that the world is rejecting, long-term bonds, unprofitable tech, will suffer. The China Investment Corporation has done the math, and they have made their decision to leave the casino. They are cashing out their chips and taking their winnings home to build a fortress economy. The United States is now left to play against itself, printing money to buy its own debt. This creates a closed-loop system that is incredibly fragile and prone to sudden bouts of volatility. We could see flash crashes in the bond market or stock market as liquidity disappears during stress events. You need to be mentally and financially prepared for a level of volatility we haven't seen since the 1970s. The great moderation of steady growth and low inflation is mathematically impossible to maintain now. We are back to the volatility of history, where empires clash and currencies fluctuate violently. The sale of $1 billion in private equity is a small number in a vacuum, but it is a massive symbol. It is the first loose stone that starts the avalanche which reshapes the entire mountain. Do not ignore the signal just because the stock market is currently distracting you with all-time highs. Markets always top out when the liquidity is at its maximum, right before it starts to drain away. The liquidity is draining away now, flowing eastward, leaving a dry riverbed behind in the west. The actions of the CIC are rational, calculated, and inevitable given the geopolitical trajectory we are on. They are not our enemy in this financial context. They are a rational actor reacting to a changing world. The real enemy of your wealth is complacency, and the belief that the future will look like the past. The future will look nothing like the past. It will look like a struggle for resources and capital. You have the information now. The data is public, verified, and undeniable for those who look. The question is no longer, will they sell? But how fast will they sell? And who is next? If Saudi Arabia follows China's lead and stops recycling petrodollars, the transformation will accelerate rapidly. We are watching the end of the exorbitant privilege of the US dollar in real-time slow motion. It is a privilege that allowed us to live beyond our means for 50 years, and the bill is coming due. But for the prepared investor, this is not a time for panic. It is a time for strategic positioning. Chaos creates opportunity for those who are not leveraged and who hold real value. The Great Unwinding clears out the dead wood of the economy and allows new growth to eventually emerge. But the forest fire must burn through the system first, and we're just smelling the smoke now. The CIC has packed its bags and left the building, turning off the lights on their way out. Do not be the last one sitting at the table waiting for a card that will never come. The game has changed, the players are leaving, and the rules are being rewritten by the victors. Make sure you are reading the new rulebook, not the one from 2010. This is the reality of the financial war we are in, and your financial survival depends on accepting it. We will continue to track every billion that moves, every asset that is sold, and every signal that flashes. Because in this environment, information is the only edge you have left against the machine. Thank you for watching this 3-part deep dive into the most critical financial story of the year. If you found value in this analysis, please hit the subscribe button right now to join our community. We are building a network of informed investors who are awake to the reality of the global economy. Leave a comment below with your biggest takeaway from this series and what you are doing to prepare. Your engagement helps us break through the algorithm and wake up more people to the truth. Stay liquid, stay skeptical, and most importantly, stay ahead of the curve. I will see you in the next video with more data, more analysis, and more truth.